Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Serve Robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath our episodes. Because today, we've got a really wild one for you.
Oh, absolutely. It's a fascinating setup.
Right. So imagine for a second that you're running a business, right? And you post a net loss margin of negative 4,121%.
Yeah, that's usually game over.
Exactly. For almost any traditional business on Earth, posting a number like that is just a complete financial death sentence. But today, we're looking at a robotics company that just posts the exact financials. And instead of panicking, Wall Street is, actually rewarding them for it.
It sounds completely counterintuitive, I know.
It really does.
Yeah.
But, think about trying to build a nationwide railroad network from scratch. You have to pay for all the raw steel, you have to lay hundreds of miles of tracks, and you're building these massive locomotives long before a single passenger ever buys a ticket.
Right, the upfront capital is just staggering.
It is, and that is the capital-intensive, high-stakes reality of scaling robotics hardware. Serve Robotics is currently transitioning from this speculative, cash-burning pilot project into a massive commercial-scale operation practically overnight.
Literally overnight, it feels like.
Yeah, they're attempting a near 10x revenue ramp in a single year, aiming to completely dominate this emerging sector that people are calling physical AI.
Which is such a massive buzzword right now. And our mission for you today is to unpack the fundamental and technical shifts happening beneath the surface here, because we really need to get straight under the hood and determine if their transition into the largest U.S. sidewalk delivery fleet is a genuine wealth-building breakout moment, or
just a money pit.
Exactly, or if it's simply an enormous cash furnace that's just going to eventually burn through all of your investor capital.
Let's unpack this inflection point because, man, the numbers here require some serious context.
They really do.
When you look at their transition from pilot program to commercial powerhouse, their full year 2025 revenue came in at $2.7 million.
Which, to be fair, actually beat their own internal guidance of $2.5 million.
True. But the catalyst, the specific metric that made all these institutional investors suddenly sit up and pay attention, was the fourth quarter of 2025.
Oh, yeah. That Q4 was wild.
They hit $0.88 million in revenue for that quarter alone, which represents a 400% year-over-year growth rate.
It's a staggering acceleration, honestly, because, scaling from 0 to 1 is incredibly difficult on its own.
Oh, for sure.
But scaling your operations by 400%, that means your manufacturing partners, your deployment teams, the maintenance crews, they all had to operate at breakneck speed without suffering any catastrophic failures.
Right. The wheels didn't fall off the wagon.
Exactly. And what really stands out to me is how management is projecting their future based on that specific Q4 momentum. They've issued this incredibly bold 2026 revenue guidance of roughly $26 million.
Which is a huge jump.
It is. To put that target in perspective for you, the Wall Street consensus was sitting at around $23.1 million. So management is not just meeting expectations, they're signaling absolute confidence in scaling up their revenue by nearly 10 times over the next 12 months.
Okay, I have to push back here, though, because as an investor looking at these financials, my internal alarm bells are just ringing loudly right now.
I don't blame you.
Let's talk about that net loss margin I mentioned at the top of the show.
Right.
A net loss margin is essentially, for those who don't know, a measure of how much money a company loses for every dollar it brings in.
Right.
So how do you square a $2.7 million annual revenue with a net loss for the year of $101.4 million?
It's a very tough pill to swallow.
It equates to a negative 4,121% net loss margin, meaning for every single dollar Serve aimed last year, they spent over $41. How does a company even survive that level of structural cash burn without going bankrupt?
Well, it is the ultimate question, and it's definitely the very first thing any rational investor should be asking.
Yeah.
Because understanding their financial safety net is critical before you even consider allocating capital here. So they survive because they've engineered a very substantial financial buffer ahead of time. Right now, they're actually sitting on a $260 million cash runway.
Wow. Okay. $260 million.
Yeah. And that capital buffer acts as a structural moat. Because for you, the investor, your biggest fear with an unprofitable company is dilution.
Right. Nobody wants to be diluted.
Exactly. Dilution happens when a company runs out of cash and is forced to issue millions of new shares to raise emergency funds, which instantly makes the shares you already own worth a lot less.
It's the worst feeling as a shareholder.
It really is. But that $260 million runway protects investors from those immediate dilution risks while the company chases that aggressive $26 million revenue target.
So it buys them time.
A lot of time. It gives them years, not months, to figure out their unit economics without constantly having to go back to the public markets with their hand out.
Okay. Which means they can afford to actually build out the physical fleet.
Precisely.
And they've been busy doing just that. We're looking at 2,000 robots currently deployed across 20 cities.
It's a massive footprint.
It really is. I want to explore the underlying mechanics of how they're building this fleet, though, because having 2,000 autonomous vehicles operating in public spaces is a pretty significant engineering feat.
Oh, well, without a doubt.
There's this concept here called the AI flywheel. And from an operational standpoint, I just think it's fascinating.
It's the core of their whole model.
Right, because, in the early days of autonomous vehicles, companies relied on incredibly expensive, really heavy sensors. You'd see those test cars driving around with tens of thousands of dollars worth of spinning LiDAR units bolted to the roof.
Oh, yeah, they looked ridiculous. And they cost a fortune.
Exactly.
Yeah.
But Serve has actually managed to decouple the hardware from the software.
And that decoupling is the secret sauce for surviving a capital-heavy rollout like this. Because they're relying so heavily on advanced AI software and data processing, rather than those expensive physical sensors, they can utilize cheaper, off-the-shelf camera technology.
Ah, so the brains are in the cloud, basically.
Essentially, yeah.
Yeah.
The intelligence is baked into the code, not the physical metal of the robot. And that specific dynamic has allowed them to cut the manufacturing cost of producing each individual robot by 50%.
Half the price. That is huge.
It is. And remarkably, while the production costs have plummeted, the computing power inside those newly built robots has actually increased by a factor of 5.
So they're getting significantly smarter and significantly cheaper to assemble, like at the exact same time.
Exactly.
And here is where the flywheel really starts turning, right? Every single mile those 2,000 robots travel acts as an ongoing data gathering mission.
They're constantly learning.
Right. They're mapping the microscopic details of city sidewalks. They're learning how to avoid a stray dog, or how to navigate around temporary construction fencing, or how to interpret the erratic movements of a pedestrian who suddenly stops to look at their phone.
Which happens all the time.
All the time. And all of that edge case data gets fed back into the central network, making the entire fleet smarter overnight.
And you just cannot simulate that kind of real-world friction in a sterile laboratory. Any competing robotics firm trying to start from scratch today is years behind on that data set alone.
It's an invisible moat.
It really is. It creates an enormous technological barrier to entry. And they've paired that technological moat with a very aggressive strategic one.
Right, the partnerships.
Yes. They have an exclusive signed partnership to deploy up to 2,000 robots on Uber Eats.
Which is massive.
Think of the rideshare and delivery ecosystem as the busiest digital commercial street in America. By signing an exclusive deal, they've effectively bought up all the prime real estate on that street.
Yeah, locking out competing robotics firms from the largest delivery platform in the United States.
Exactly. And when you add in their planned expansions with DoorDash and White Castle, they're embedding themselves so deeply into these multi-platform utility spaces that they just become indispensable.
Okay, I mean, it sounds like a bulletproof strategy on paper. But yeah, here's where I get hung up. Delivering a fast food burger or a burrito is a notoriously low-margin game to begin with.
Oh, absolutely.
The delivery companies themselves struggle to turn a profit on this stuff. You're at the mercy of unpredictable consumer spending, terrible weather conditions that keep people indoors, and very low average order values.
Yeah, nobody's getting rich delivering a $10 taco.
Right. So is delivering fast food really enough to justify building a multi-million-dollar physical AI infrastructure?
See, that is a highly valid concern, and it's a skepticism that Wall Street heavily shares right now.
I would imagine.
Because relying solely on consumer food delivery is incredibly risky. You're fighting for pennies on every single transaction.
Yeah.
Which is exactly why the company recently executed a major strategic pivot to diversify its income completely away from the city sidewalk.
The Diligent Robotics deal.
Yes. They recently acquired Diligent Robotics. And this introduces a completely new, highly lucrative dynamic to their business model, which is hospital contracts.
Hospitals. That's a totally different ballgame.
Completely different. This single acquisition is expected to generate roughly $7 million in recurring revenue in 2026 alone.
Okay, let's break down why that specific word, recurring, is just the absolute holy grail for investors looking at this stock.
Oh, Wall Street loves that word.
Wall Street places an enormous premium on certainty. If a robot delivers a coffee on a sidewalk, the company makes a $2 fee once.
Just once.
Right. To make that money again tomorrow, they have to hope that same customer decides to order another coffee. It's transactional, it's weather-dependent, and highly volatile.
Exactly.
However, if you sign a multi-year enterprise contract with a major hospital network, you're locking in a guaranteed, say, $10,000 a month, every single month, for the next 3 to 5 years.
It's night and day.
You can build a reliable financial model around that predictability, and institutional investors can base a strong stock valuation on it.
Totally. And to fully grasp the value here, we really need to understand what these hospital robots are actually doing to justify those expensive enterprise contracts.
Right. They're not doing surgery.
No, they are definitely not assisting in surgeries. Diligence robots, primarily their flagship model, which is named Moxie, they're designed to solve a critical healthcare labor shortage by essentially taking over fetch quests.
Fetch quests. I love that.
That's really what it is. A floor nurse can easily walk several miles during a standard 12-hour shift just carrying blood samples down to the lab in the basement or, retrieving clean IV bags from a supply closet.
Which is such a waste of their expertise.
Exactly. So when a robot handles those repetitive point-to-point logistical runs, the hospital reclaims thousands of hours of highly specialized, expensive human labor.
Wow.
The nurses get to stay at the bedside with the patients, and the return on investment is immediate and obvious for the hospital administrators.
Okay, I see the financial logic perfectly. It looks phenomenal on a spreadsheet, but operationally, talk about extreme whiplash.
Oh, for sure.
Acquiring a company is not just buying their revenue,
Yeah.
You're inheriting their tech debt, their corporate culture, the engineering challenge of navigating a rugged sidewalk full of potholes and unpredictable bicycles is entirely different from navigating a sterile, highly regulated hospital ward alongside doctors and critical care patients.
It's a completely different environment.
Are they stretching their core competency too thin by trying to build hardware for the chaotic outdoors and the highly structured indoors at the exact same time?
It's the classic risk of rapid expansion and the execution risk of merging a sidewalk delivery culture with a clinical healthcare culture is non-trivial. It's tough.
Yeah.
And that specific tension, between the skepticism over whether they're stretching their operational capacity too thin and the optimism over locking in high-quality recurring revenue, that is what triggered a very violent reaction in the stock's recent market pricing.
Which perfectly brings us to the technical setup in the recent market breakout.
Let's get into the numbers.
Let's look at what happened following their Q4 earnings release on March 11, 2026. They reported an earnings per share, or EPS, of negative 46 cents.
Right.
Now, for those new to the metric, earnings per share is simply the company's total profit or loss divided by the number of outstanding shares. In plain English, they're still losing nearly $0.50 for every share of stock out there.
Which sounds bad on the surface.
It does. But here's the critical part. Wall Street was bracing for them to lose 49 cents.
So they beat the estimate.
Exactly. Because they beat that dire estimate by just 3 cents, the market went wild. The stock exhibited a classic technical breakout, jumping 14% to $10.90 in pre-market trading.
And the volume behind that pre-market jump is the crucial indicator you need to pay attention to here.
See more about that.
Well, when a stock moves 14% before the market even officially opens on exceptionally high volume, that's not just retail investors trading on their phones out of a fear of missing out.
Right, mom and pop aren't moving the market that much at 6 a.m.
Exactly. That is institutional accumulation. Hedge funds and large asset managers were reading the tape and executing massive block trades. The smart money was actively stepping in.
We also have to factor in the short sellers here, because the short interest on this stock is incredibly high, which creates a highly combustible environment.
It's a power keg.
It really is. Let's break down how a short squeeze actually functions in practice. When investors short a stock, they're borrowing shares they don't own and selling them immediately, betting that the price will drop so they can buy them back cheaper later and, pocket the difference.
But when the price goes up instead?
Exactly. When a company posts a surprise earnings beat and the stock suddenly jumps 14% upward, those short sellers start bleeding money fast.
They panic.
Yep. To stop their mounting losses, they're forced to buy shares at the current high price to return the ones they originally borrowed. All of that forced, panicked buying drives the stock price even higher, which forces even more short sellers to buy in. It just creates this violent upward feedback loop.
And that upward momentum is being heavily supported by institutional analysts right now. Cantor Fitzgerald recently maintained an overweight rating on the stock with the $16 price target.
$16.
Yeah, so if you're looking at the $10.90 level from that initial earnings breakout, a $16 target implies roughly a 69% upside from current levels.
That's massive upside. But, we have to look at both sides of the coin here because the battle between the bulls and the bears is just fierce right now.
Oh, they are at each other's throats on this one.
The bear case is rooted in what critics call immaterial progress. The bears look at the low per-robot revenue economics on the food delivery side. They look at that astronomical $101 million cash burn, and they argue the company is essentially subsidizing every single delivery at a loss just to show top-line growth to keep investors happy.
Basically buying growth.
Right. To them, it's a house of cards. But the bull case completely counters that narrative by pointing to the 2,000 robot milestone.
It's fair.
Yeah, to the bulls, deploying 2,000 robots across 20 cities is not just some fun marketing statistic, right? It's a profound de-risking event. It proves the physical hardware actually works in the real world at a commercial scale, which is undeniably the hardest part of the robotics equation to solve.
It is. And when you contextualize this for your wealth building strategy, the smart money is using the current volatility to build their positions. We're watching market psychology officially shift in real time.
The narrative is changing.
The broader narrative is absolutely moving away from viewing this company as a speculative pilot program, and it's shifting toward growth validation. Institutional investors, they're no longer asking if the robots actually work. Now they're looking for validation that the business model can scale to profitability before the cash runs out.
Okay, so I was looking at the calendar for the next 6 to 12 months, and there are a few specific events you really need to watch to confirm if this bullish thesis is actually playing out in reality.
What's the first one?
The first major hurdle is Q1 2026 earnings, which are estimated to drop around June 2026. This is the ultimate make-or-break moment where management has to prove their quarter-over-quarter trajectory is legitimately on pace to hit that aggressive $26 million goal.
Yeah, if they stumble here and show slowing growth, the market will punish them severely.
Brutally.
You also need to heavily monitor the Diligent Robotics integration updates. We need to see hard-proof, actual press releases and sign hospital contracts showing that the projected $7 million in recurring healthcare revenue is materializing.
Because acquiring a company is easy?
Buying a company is the easy part. Extracting the projected value from that acquisition is incredibly difficult.
Very true. Third thing on the calendar is the expansion into new enterprise verticals. Following their recent deal with White Castle, we want to watch for new corporate clients signing on.
Any expansion beyond standard consumer food delivery into automated logistics or, say, corporate campus deliveries signals that their multi-platform utility is actually gaining tangible traction in the broader market. Finally, there's a substantial macro tailwind to consider. The broader market is currently rotating massive amounts of capital into physical AI.
Yeah, the money's definitely moving.
For the last few years, all the major investment dollars flowed into software-based AI, like large language models and text generators. But now, institutional funds are actively looking for companies applying artificial intelligence to the physical world.
Right, like robotics, autonomous driving, automated factory logistics.
Exactly. Serve is positioned as a pure-play leader in this emerging theme, meaning they'll naturally benefit from that sector-wide capital rotation.
Okay, bringing it all together for the final score, how are we grading this setup?
The final verdict is a bullish score of 7.5 out of 10.
Okay, 7.5.
Yeah. You have an extremely high growth potential, driven by an impressive technological moat and a lucrative pivot into healthcare. However, that upside is somewhat offset by the execution risk of integrating a brand new acquisition, combined with their current state of deep unprofitability.
The cash burn still looms large.
It does. The target horizon here is a medium-term hold, roughly 6 to 12 months. You really need to hold through those upcoming earnings cycles to actually witness the revenue inflection take hold and confirm the acquisition synergies are actually working.
Which brings me to the ultimate challenge for you, the listener. You have to ask yourself a very tough portfolio question right now.
It's gut check time.
Truly, are you risk-tolerant enough to ride out the inevitable gut-wrenching volatility of a highly shorted, unprofitable, pure-play stock for the next 6 to 12 months, purely based on its asymmetric upside?
Because realizing that asymmetric upside requires absolutely flawless execution from the management team.
Exactly. To distill the core wealth-building takeaway here, Serve Robotics is offering a high-risk, high-reward opportunity on the autonomous delivery megatrend. Yes, they are backed by substantial cash reserves and formidable monopolistic partnerships like Uber.
But turning a cash-burning pilot program into a profitable commercial powerhouse requires absolute precision in their daily operations.
It does.
I want to leave you with a final, lingering question to ponder as you research this sector independently.
Let's hear it.
If Serve Robotics successfully proves that their physical AI flywheel, where computing power increases fivefold while production costs are halved, if that can actually generate high-quality recurring revenue in both complex hospitals and chaotic city streets, what does that mean for the broader tech market? Could physical robots eventually achieve the exact same lucrative profit margins that Wall Street currently only expects from software companies?
Man, it is a fascinating thought, because if hardware can scale with the same margins as software, the entire valuation model for physical tech changes overnight.
It really does.
Well, thank you so much for joining us for today's stock analysis. We will catch you on the next one.